I do too. Thank you. I'll be back in.
You know what, I should.
Hello.
I gotta get some water.
Oh, all right. Yeah, I don't want to. That's good.
Yeah, it's a nice way.
Oh, wow, that's cool.
It's so much fun.
Sweet.
How are you?
Yeah. Plugging away.
Got it.
Okay, so this is
Do it again tomorrow, though.
Shower,
good job.
I don't know exactly it.
Every day.
I think of you.
You know, I could get used to this. Like once or twice a week.
If you keep saying that for a while.
Hello, how are you? Good.
Don't work out like these days.
I'm gonna have her work on a few. Hey. I'm gonna have her work on some things for. So when I was there, she was. Yeah, of course. Absolutely. I'm so glad it worked.
Isn't burned out yet? It's burned out yet. So, most part, it's good.
Yeah. Yeah.
Nice to meet you.
He's
still moving. I'm surprised.
I'm planning anything, I just pulled something from before, so. Yeah, no. I have just some back.
Right.
He's like, he's wired with one of those. There we go. And then he just comes down from it, so Saturday, Sunday.
But here last night. Now I'm like, do they sleep late or?
Are they still sleeping?
That's all.
Yeah.
Like, I don't, finally I said, is there anything that offers us possible? Like, if you were friends with them, I'd be like, oh, you can sit here with them.
But it's from how.
I can't use their name. I need some kind of,
No. She was nice, she just, they had like, she would hop around from office to office, she was there for so long. And
So they're hoping that you won't actually work. And find out next month, what things I'm doing for sure. Otherwise, other than that, they bring you to a trial, and then it's, okay, number one, you go home, I don't know what work for you. So, but, try outward.
she's like,
You're gonna laugh.
All right, love the hands-on stuff.
Colin, I logged into your calls yesterday. I was like, okay, I'm back. I'm ready. I logged in at 9:27. I'm like, where is he? Oh, do not have it it in my calendar that it had started tonight.
I was nowadays like, yep, I was 5 minutes late.
Well, you were done by the time I logged on.
I lost track of time. And then you got her to. So you drop the tree, it's just like there.
I think others might have thought it was 9:32 because I kept sort of hearing the ding ding, like when someone, but I'm like, literally, I'm finally get on, where is he? I'm 3 minutes early. I reached out to Kelly, she's like, that was moved to 9 a long time ago. Sorry about that.
Okay, everybody. Thanks for, actually, you know what? I've got a bone to pick with everybody. Why is there so many people in here when I'm not talking?
Because it's Paul.
Yeah, exactly, because it's Paul. And the room should be full for Paul. So, I'd like to introduce and welcome Paul Miller. Paul is the founder of Business by Design. They are a firm who really prides themselves, and maybe correct me if I'm teeing this up wrong, Paul, but they really pride themselves on working especially with real estate professionals and real estate owners and small business owners to maximize the advantages that we can find in the tax code based on what we do. Not bad.
I'll take that.
Okay, all right, so for a rookie, that's pretty, maybe I'm auditioning for it, I'm not sure. So, Olivia and I have personally worked with Paul for, I don't know, it's quite a while now. We sat down to talk to Paul about our particular situation, what we do, our our tax situation quite a while ago. We left that hour-long discussion, hopped in the car and said, I'm writing the check right now because nobody has ever talked to us about our tax burden and how to work with it like Paul and his group did. So we've had Paul here before, for those that have been around a while. We thought this was the right group to bring Paul back to talk to. And I think we'll probably cover a few different topics, but maybe a little bit about real estate agents and their tax scenarios and just some general ideas as to how he can help with that. And then talk about investment properties, some of the benefits from a tax perspective there. And then cost segregation. That was another one that came up from the group when we polled everyone as to what would be a valuable topic. That was a big one that came up. So, and I can personally say that I have benefited significantly from that particular strategy in working with Paul and his group. So with that, nobody came here to listen to me babble, so we'll let Paul babble in a much more cohesive way than I do.
All right, thank you. Hello, everyone. I like that saying over there, don't listen to your drunk monkey. So I'm not quite sure what that means, but I'm sure it means something different to everybody. So
Stick around,
you'll find out. All right. So as Colin said, Paul Miller, owner, founder, Business by Design. And consolidating what Colin said, I mean, the main thing we try to do is really just teach people that there's another way to do certain things. And as you know, in the industry you're in, real estate, when your clients have questions on transactions, what to do, you can be a facilitator with information and knowledge. And really, that's all we try to do as well in the world of tax. That can be super confusing, okay? And I know every one of you loves dealing with your taxes, right? It's funny because it's one of the greatest misconceptions I think that is out there for most people when it comes to anything tax related. I think it's just like huge mystery black box. And part of it is driven by, really, quite frankly, the accounting industry. They make it seem a lot more complicated than probably what it needs to be. It's just simple math in a lot of ways. And the number one thing that I'll hear from people, and we have over 750 entrepreneur clients. 2/3 of our clients are real estate related, agents, brokers, developers, contractors, that kind of thing. And I'll tell you, most people go like, this sucks. I don't want to deal with it. Tough. It's what you signed up for when you're running a business. And here's what I'll tell you, And you don't have to hear it directly from me, but I'm going to tell you, fast forward, the one thing I've learned in almost 30 years of running a business, taxes are going to be part of your life forever. Might as well learn something about them. Okay? You don't have to be an expert in this stuff. You just have to be conscious and aware about things that are happening to you. I use my example of my mother who passed away a number of years ago, but I grew up in a family of 9 siblings, okay? And yes, that was planned by my mom and dad, I'm sure. So I like to say, my mom and dad weren't really good planners. Things just kind of happened. I grew up on a farm, so you just kind of dealt with what's there. And I remembered when we got to a point in my mom's life, we were dealing with her estate and what was happening with our farm and what would happen if she went into assisted care. Some of you might have had to deal with this. And I go to my mom and say, hey, you got to understand, this is the irony of life. You work your whole life to save money and build equity, and at the end of your life, they take it all away from you before you die. That really sucks, right? So I said, you know, we got to come up with a way to do something. And my mom would always be like, oh, Paul, I don't know, it just seems so complicated. And, you know, so I was nominated by my sisters. I have 7 sisters, yeah, for me. And so they would say, Paul, go talk to her again. Go talk. So for like 3 years, I talked to my mom about what we needed to do. And finally, the last year, the 3rd year, I went to her and I said, Mom, you gotta understand, no plan is a plan in and of itself. Doing nothing is a plan. You're gonna get a result. And that's how I feel about taxes. Doing nothing, you're gonna get a result. The question is, you can't play the victim role. You have to be able to empower yourself with information. And if you're gonna run a business and you're gonna be involved in business, and I'm gonna delineate the 2 things here to say you got your real estate commission business and then you have maybe rental or investments, okay? They're 2 different businesses. If you're going to be involved, then you need to start being aware of certain things that could potentially have an impact on you. That's all, okay? And probably more than anything, what we want to be able to do is just shed the light that there are options. There are things that you can do that are different. You just might have to choose a different path, okay? About this time of year, and everyone thinks of their taxes and getting their taxes done. Getting your taxes done is purely a task. Someone put a due date, you got to get something done. If that's when you think about your taxes, you are going to get a result. The question is it the end result that you're looking for, okay? So the idea is, conceptually, in running your business and understanding what you want to do, and this is moving beyond, you know, I don't know what stage of business some of you all are in, but you start out in real estate, you just hope to start making the money, pay the bills, start getting going, right? And then one thing kind of leads to another, maybe you build a little bit of success. And how many of you had 1 year, we go, your income's like here, the next year you made a little bit more and you go, holy crap, why do I owe so much more in tax? Okay, this is math. Math kicks in because at some point we have to understand how your income is earned and what you do to how you're going to pay your tax, okay? The other thing I'll say on the real estate commission business, for most agents, essentially your business is a stair-step business. Oh, is there something?
Pardon me.
You ran really fast, like it was going to blow up. So.
I was mad about my taxes, dude.
What was I going to say? Sorry. It made me lose my train of thought.
Sorry, dude.
That's all right. It's all good.
Stair-step business.
Oh, stair-step business. Thank you. Thank you for taking notes. So, as a real estate agent, your business is what I call stair-step business. You have a bucket of expenses that you have to kind of just run the business. And for most agents, that could be 25, 35, maybe 40 grand of expense that it takes just for you to open shop, right? And whether you make 70 grand a commission, 100 grand a commission, 120, it's probably going to cost you about the same. The difference, though, in your commission revenue changes is pure profit. It's all exposed to tax. So one of the things we'll talk about here, I like to jump into, and I've got a variety of slides. I'm going to jump around because I wasn't really prepared for this. Olivia gave me this notice, okay? So
I didn't get
I
that. You were supposed to say that.
Okay, oh, sorry, that was behind the scenes. So, but I can share some things with you, and I'm going to go to first this. So in the world of tax, I think one of the things you want to look at is separating your tax situation in 2 pictures. One is active and 2 is passive. An active trader business is what you do to work and make your money. That's the most expensive type of income you can earn because you're going to pay Social Security Medicare tax, that's a 15.3% tax, plus Fed and state, whatever your Fed and state tax rates are. On passive income, that's an investment. Passive income, historically, again, is always less expensive than active. So your real estate commission business is an active trader business, you pay the 3 types of tax. On a passive activity, that would be like an investment, interest income, dividend income. Rentals are considered an investment. There's no Social Security tax, and you pay Fed or state income taxes on income you earn, and the potential is there for capital gains. So if I'm a property investor and I have rentals, I could buy something, rent it, turn around, sell it, have a gain. That gain could be taxed as a capital gain. Capital gain tax are typically more favorable than income tax rates. If I buy a property, fix it up, and sell it, falls a little bit more in that question mark. So what's my intent with that property? If I'm a flipper and I do this on a regular basis, the IRS would say that's a business, that's over here. So the nature of what you do will determine what side you fall on. That's also going to determine how you structure yourself, okay? Typically, yeah, I'll get to your question. Typically right here, this side of active trader business, most people are going to want some type of corporation or entity like S Corporation to take in your income. If you're profiting more than probably 50 grand, S Corporation is typically the most preferred tax method that you're going to choose, tax strategy over here. Over here, whether you own an investment personally or whether you own it in an entity doesn't matter, it's tax neutral. I might say I might buy investment property and I put them in an entity, but that's for asset protection, it's not for tax planning. Yes, you had a question?
I was just curious what defines regular basis when flipping properties.
Yeah, so here's the rabbit hole we'll go down on the flipping property. So, no, but it's a good question. So, generally speaking, I buy a property and the IRS will use this definition of what your intent is, okay? What is your intent with that property? So you buy the property, you go, I don't know. I might flip it, I might rent it, whatever. The problem is the IRS has the luxury of looking back in time. When they ask you that question, it's 2 years after the fact that happened. So present day you buys a property, you fix it up, you say, I'm gonna rent it. A rental property is a passive activity. Your intention is to rent the property. If I buy a property to fix it up and my intent is to flip it, okay? Maybe the first one I could get away and say, this is just an investment. It's trying something out, okay? The problem is that people that do that and are successful at it, after the first one, what do? Then do another one. Hey, sweet, I'll take the profit in this and I'll put it in the next one. I'll double down. So now over the course of a 12, 24, 36 month window, the IRS sees, hey, you've done this 6, 7 times. That's now a business. It's not an investment. You see what I'm saying? So it's not a clear line, and you'll find many things in tax. There's a rule, and then there's 100 exceptions around different rules, okay? But that's the concept of it. So the idea of passive activity primarily involves your time that you're spending on something. So let's say Colin and I own a flipping company together, okay? Buying, selling property. Me being me, I don't want to do any work. Colin does all the work. I'm just an investor. I just put the money in. He does the work. Technically, he would be subject to Social Security tax. I would not be as an investor. So it can be based on characteristics, what you do, and or the time that you're spending in that business. What is your job? What is the work that you're doing? So think of someone as an investor. I just put the money in, see what happens. I don't do anything with it. Now you can say that with rentals. I put money in, buy a property, I work on the property, whatever. Yeah, but you collect rent because you own the property. You don't collect rent because of you. So that's the nature of it. Does that make sense? Is that clear, everybody? So there is a line between the two, and how you might structure that if you are considering like buying and selling, again, as we fall into different opportunity pricing based on where markets are, you could do 1 or 2 and call it a passive activity, But eventually, if you do enough of it, they're gonna say, you're in the business of doing this, you might have to structure that differently, okay? Okay, let's see what else we have. Oh, Social Security Medicare tax, I just review this with people. So what is Social Security Medicare? You work for someone else, your employer pays half, you pay the other half. When you're self-employed, you pay the whole thing. It's a 15.3% tax. Last year's earnings was 160. There's a threshold for that, up to 160. This year's 168.6, I think it is. So the point is, if I have a business and I make 100 grand profit, I pay 15.3 on the entire 100. If I have a business and I make $1 million profit, I would pay Social Security tax up to that limit for that year. Last year was 160, this year 168. Medicare tax goes to infinity. So in that bucket, you got Social Security and Medicare. Social Security is capped, but Medicare goes on. This is a tax that's going to be on your business, on your real estate business, commission business. A Schedule C sole proprietorship is going to be taxed a little different than an S corp. But this is a big tax that people have to consider when they start making money. Now, if you look at your tax return, a couple terms that you want to know. First of all, this is an example of a front page return. Line 9 is going to be your total income. Your total income is typically what a bank is going to look at and say, hey, what's your income, right? That's the number a bank is going to look at primarily. The bottom line, line 15, is your taxable income. That's the number you pay income tax on, okay? So we pay Social Security Medicare tax on our profit from our business. We pay income tax on that number. They're different numbers. Now, these are the tax tables. This is married, filing, joint. And again, I like to review this so people understand taxes to a certain degree. So this is single taxpayers, married, filing, joint. There's 4 different tax statuses. But if I was in this example of 122 taxable income, married, filing, joint, I would be falling into this tax bracket right here. So for the first 23,000 is 10%, 23 to 94 is 12, 94 to 122, that portion of income is going to be taxed at 22%. And why that's important to you is that that's what your marginal tax rate is. So your last dollar you earn, what does it tax at? That's the giant question for people. Because when you go to someone as your accountant or someone and say, hey, should I do this? Should I buy this? Should I make this move? What happens with tax? We're impacting the last dollars earned, okay? So my marginal tax rate in this example is 22% Fed. I can see that I'm going to be at roughly 7% to the state down there. So that's 29%. And if I add Social Security tax to that, 15%, I can go, well, that sucks. Yeah, it does suck. People don't sign up for a tax or business model that says, hey, you know that model, you're going to pay 40, 50% tax? That's the one I want to choose. Remember I said about decisions are made for you? That's what ends up happening. So the thing I learned way back eons ago about tax is that you have to understand the mechanics of how you're actually generating your income and what the nature of that source of that income is in order to fix it. Because if you're trying to say, what can I do different? What can I do to change? Someone says, well, I owe this tax. I don't want to pay tax. Great, write me a check. It's a business expense. I'll pay the tax for you. You have no money then. The goal is you're trying to improve your net worth. You're trying to pay for the bills you have, maybe make an investment, move forward in life, but do it in a tax efficient way, okay? When you have no money, you pay no tax. Very simple. Yes, Tom?
Okay, so for those that have been part of this group for the last while, we did an exercise as to where everybody currently is and where they're earning their income from, right? We had the employee, we had the self-employed, we had business, we had investment. And then we looked at it and said, okay, where do I want my income to come from in the next 5 years? And what am I going to do to get it there? Bringing Paul in after those 2 minutes of discussion, can you see why that thought process is so important?
So here's the way taxes
The
work.
building moving forward.
I'm sorry to interrupt, but
Yep,
just
go ahead.
the concept of tax is simple. If you're successful in making money in our tax system, it's 2 steps forward, 1 back. That's the model. It's math. If you're an investor, it's 3 steps forward, 1 back. That's the difference. So you say rich people don't pay tax. Yeah, they don't pay all the taxes. They pay different taxes. There's different types of taxes. If you work to make your money, you're gonna probably pay the maximum amount of tax. So the challenges for most people, and I mentioned, I have 9 siblings. It's not like when my mother and father passed away, I got an inheritance. I asked, how much do I owe? That's the question I asked. The hardest is getting that principal equity, that first base of equity. That's the challenge. If I had a rich relative that handed me $1 million, they paid the tax on it. I got the $1 million tax-free. I can start with that and move forward. But how do I get that first $1 million? That's the question for most people, and that's what the challenge is. So when you're in the model where you have to move forward, pay tax, move forward, pay tax, it's very difficult. It takes a lot longer than you think to create the type of lifestyle and get the net worth that you want. And tell me if you feel this when you go like, I think I made more money, I think I'm moving ahead, and all of a sudden you go, how do I have no more money? I feel like it's the same thing. And that's because taxes. And for most people, and I'm gonna forward something. I want to show you something here, come back. So for most people, if I look at this as married, filing joint, this is what is a concept that is pretty consistent. So if I could pay 10 or 12% federal tax, that's very inexpensive, okay? If I'm in those brackets, I'm not reaching for deductions. I don't want to be that aggressive with deductions because that's pretty inexpensive as compared to when I'm out here. So if someone is 94,000 of taxable income, that means they could probably have income in their household, maybe around 125 grand. So people live in the metro area, say a family of 4, make about 25. How much money do they really have? Not a lot. That money they make basically goes to, what I say is they eat and sleep in it. Okay? You don't really pay tax at this point. Someone makes 100, 125 grand or under, most of that tax they get, there's some child credits if they have kids and other things. There's not a heavy tax burden. Okay, so now I take that same person, 125 grand, and a few more things fall their way and they make 100 grand more because they're successful in their real estate business. What happens? Now they're being taxed at these rates down through here. But in their mind, they go, wait a second, my first 125, I had this much money. In my mind, my next 100, I should have this much more. It gets diluted way faster. So the challenge for most people, when they actually have money to do the things that they want to do, and I'm going to summarize most of your goals and dreams and ambitions: reduce debt, save money, make an investment, pay for my kid's wedding, pay for education, improve my house, go on vacation. Kind of nailed most of them, okay? I'll tell you what, those are all non-deductible. Everything non-deductible has a higher cost. So the challenge for people is the fact that what they want to do in life to move forward is typically non-deductible. Our tax system is set up to reward you to spend money on your business. The IRS doesn't want you to save money. Sounds weird, right? They don't want you to have money in your bank account. They want you to spend it. They want you to hire people, buy equipment, buy office supplies, whatever. That's what they want to do. They'll incentivize you to do that. They don't incentivize you to go like, I'm tired of having 0 money in my bank account at the end of the year. I'd like to have 100 grand. Well, how do I get 100 grand clear in my bank account? I might have to make $150,000, $160,000, pay tax. That's how I get it. Okay? Who's depressed?
Thanks for coming.
All right, see you later, Colin, take it over from there. So my point that I try to make on that, and I spend time on this just because I feel like the math percentages twist us around. And we just have to understand that everything we want to do probably costs us a little bit more than we think. And I've said this before, but I'll say it again, probably till the day I stop doing this stuff. I use the gas station example. My wife went at the gas station, gas says it's $4 a gallon. The sign over my car is correct. I can earn $4 and buy 1 gallon of gasoline. The sign over my wife's car is incorrect. It says 4, it should probably say 7. We need to make $7, pay tax. That's how we get 4. Because everything she drives is non-deductible. It's driving my kids back and forth to dance, to volleyball, whatever. That is our pricing system, our tax system in a nutshell. And you can say, that sucks, that depresses me. Hey, I didn't make the rules. I'm just telling you, this is what it is. You have to understand what you're trying to do. And by forcing more money down and just paying tax, that is not really the idea that most people want to have. So that's that concept around marginal tax rate. Any questions on that? Anybody want to move to Canada?
I won't do that.
No.
I said Canada's worse.
So basically, the government just wants us to live like the government lives and just, right? Is that in a
Spend more than you
nutshell?
make,
Open that up for discussion amongst yourselves as you would like.
I don't,
But the thing, here's what I'll say, that there are options, but this is where you have to arm yourself with information, right? So when I go out and I'm trying to earn and become profitable in my business, I then have to do some things that potentially have an offset, okay? So one of the luxuries that you have in the world of real estate as a real estate agent is you have the opportunity to fill the cylinder of your active trade or business income, but you might be able to do something in, we talk about rental or real estate investments that can come and offset that. Every one of you, I'm guessing here, as a real estate person, as a real estate professional, has a distinct advantage over me when it comes to that, okay? And I'm gonna jump to, sorry, I think I have this in here. Okay. Passive losses. So when we have rentals, okay, and I say I made 200 grand on my business, and it doesn't matter if I'm a Schedule C sole proprietorship or S corp. Let's say my business generates 200 grand on my personal return, and I want to try to use some rentals to offset that. Well, how does that happen? People will think there's some kind of magic that happens with rentals. It really isn't. It's pretty straightforward. And I'm going to go back and reconstruct this and show you a rental tax reporting, okay? So this is a Schedule E that rentals would be reported on. I've highlighted a couple things here. I've got a rental property. This is how it's reported to the IRS. I've got my property. I have the type of property that's listed here. We determine, is it a full-time rental? Is it an Airbnb? Is it a commercial property? There's some distinct differences when it comes to tax. I'm not going to get into that right now. This is very important. I find more and more people doing things like VRBO, et cetera. You need to have a property that's rented or available for rent. So I buy a property today, it's uninhabitable, and I start fixing it up. It takes me 3 months to fix it up. I can start deducting stuff once it's rented or available for rent. That's when it's kind of placed in service. It's not always the purchase date. I ran across this because I had this conversation yesterday with someone. So now, once it's rented or available for rent, I can use it for 14 days personal use myself. Outside of that, if I use it for 14 days or less in a year, it's considered a full-time rental. So you want a property, if you have an investment property, you want it to be considered a full-time rental. That's the best case scenario. If you have a property, the client I was talking to has a property in Florida, has an Airbnb, stayed in it 3 months out of the year, roughly, okay? So of the 12 months it was available, 3 months he stayed, 9 months was rented. It's a mixed use property. So he only gets a portion of deductions. Whenever you consume something personally, then it's basically non-deductible. So, 3/4 of the costs of things he would be able to write off, 1/4 non-deductible. With mixed use property though, I can only deduct expenses to the extent there's income. I can't take it to a loss. A full-time rental could take a property and push that to a loss. So we look at expenses that go against this particular property. I can see I got my rents, my expenses listed. I've got my depreciation. So depreciation is always kind of a mystery for people, but single family or a residential rental is 27.5 years. You buy property for 300 grand. Let's say there's land, the building, the house that goes with it. You take out the cost of the land. Let's say the land's 50 grand. The building's 250. You take the 250 divided by 27.5. That's your annual depreciation you're going to get on that property. Okay? So that's the stuff that's going to come in on this line here. In theory, I could have a property that's money in, money out, breaking even or cash flow positive, but it would push it to a tax loss because of depreciation. So this particular property has a loss down at the bottom. That loss, that negative 3290, could come in and offset my income from my business. Now, this is the breakdown of depreciation. I said residential rental, 27.5 years. Non-residential, that's commercial, 39 years. There's no depreciation on land. Okay, so you have to allocate out, if you buy a property with land, you got to allocate out the cost for the land.
So if you're renting land, do you have to it's just income?
Correct. So yeah, if you have farmland that you're renting, the land you don't do anything with, the land improvements you can do something with. You put fencing on it, you do different irrigation stuff, whatever, that's all, you can deduct stuff that goes on the land, but not the land itself. Furniture and fixtures, you can see are broke down differently. So here's the example. I was actually right in my example. I'd done this a few months ago. So 300 purchase price, allocate 50 up for the land. This is my annual depreciation. Think of it like you take that divided by 12. That's kind of what I get per month. So when you make a mortgage payment, you're making a payment, you got interest and principal. The first payments you make, interest, principal, right? Big part interest. So the principal, if I'm making a mortgage payment on this, let's just say the payment's $1,600, maybe $1,300 of that could be interest, 300 principal. So 300 times 12, that's 3,600. I'm getting more than that in depreciation. That's why this thing is going to a loss. Early on, properties will, even if they cash flow, could show a tax loss. Okay, that's not a mystery, it's just a mathematical fact. So when we have this loss, the question is, what happens to it? So TCJA, which impacted everything we talk about in the world of tax, starting in the years of 2018 to 2025. It's the CARES that's going to turn into a pumpkin here coming up. When this passed, I remember we talked about a lot of this stuff. I've talked in this room a number of things about TCJA for business, qualified business income, certain things that happened that were very favorable for taxpayers. They are magically, at the end of 25, going to go away. We're supposed to go back at the end of 25 back to what it was in 2017. So we'll see how that works. As you know, our political system, things happen really quick. So we should have a quick answer on that, no problem.
Right.
Point being, when all these laws change, it seems, that's 2025's problem. I'll worry about that out there. Well, we're coming up on that, okay? So one of the things you want to start paying attention to is TCJA is ending. And what that means is for things like investment properties, there was this bonus depreciation that came in place. The first few years of that life in 2018, 2018, there was 100% bonus depreciation. So if I bought a property and I fixed up a bathroom and I put 20 grand into it, I could write that 20 grand off right away. Before TCJA, I couldn't. So there's a significant advantage for real estate investors with this bonus depreciation. Well, then they had this schedule in there when the law passed. They said, okay, we'll do this for a while, and then it's going to go to 80%. This year it's 60%. Okay, so last year, 2023, I know it's worded weird, but that's how they word it. Last year was 80%. So I put 20 grand improving a bathroom. I buy a property, fix up the bathroom for 20 grand. I could get 80% of that as a straight right-of-way deduction. This year I do that, it's 60%.
Is that true with like new furnaces and central air too?
Correct, yes. There are certain things that you can use section 179 on, some roof stuff or whatever, but yes, the mechanical appliances, things like that. So this has been in discussion the early part of this year. They've been trying to nudge this back to 100%. There's a bill that passed the House, it was in the Senate, trying to get this back. Nothing's happened. Again, it's
Get
our
the
government.
improve,
So,
get the improvements done just in case.
yeah. So point being is that this is all sunsetting. So the clock is ticking on a lot of these things. Something's gonna change. Now, I've been around tax long enough to know once, Pandora's out of the box, they're not putting it back in. So they're probably not gonna go back to exactly what it was before, but there could be some differences. So bonus depreciation was a big win for anyone in business and in rental. The other thing that pairs with this is qualified business income, QBI. That's that 20% business deduction. Anyone in business, whether you're a sole proprietorship or S corp, right now you're getting the benefits of a 20% of your profit is a phantom deduction. You're getting a tax deduction for money you didn't spend, what's called QBI. That's set to expire here at the end of 25. So just understand that these are like shifting sands, that things are going to be evolving and moving. But this had a big impact on cost segregations. So a lot of people, when this came about, were able to be more aggressive with depreciation. Colin used his example because they were able, these cost seg firms were able to allocate more money to things that get larger depreciation, okay? And depreciation just means I can shove it against income, convert it into a loss, okay? Now, what can I do with that loss? I'm gonna go down past this, I'll come back. I got to here. So this is something that you need to kind of make sure you're clear about. So let's say I've got 200 grand of income and I've got multiple properties. Let's say I've got a $50,000 loss. And I go, all right, sweet. I could take the 250 and the negative 50, put them together, I'm at 150. The IRS says, well, wait, maybe. You have to pass some tests first. The first test is what's called material participation. So material participation is an important test. I'm going to get to a couple of reasons why. Oops, here it is. It's a 100-hour test. So I'm just going to use a couple examples. I've got 5 properties. Each of them had a $10,000 loss, $50,000 loss. I collect the rents. I'm involved in the property management. I'm doing stuff with it. It's pretty easy to meet that material participation test. So I can pass this one. I can check this one off. The second one is real estate professional. Now, all passive losses have limitations. First, I got to be materially participating. Second is there's an income limit. When my income goes beyond 100 grand, I don't get real estate losses. You go, wait a second, I have seen myself buy a tax return, I get to deduct them. I have to claim real estate professional in order to get them. So my income was 200, I got 50,000 loss. Can I take that 50 and offset the 2? If I was a real estate professional, I could. So what is a real estate professional? Here's the IRS's definition of what a real estate professional is. More than 50% of services, real property trades or business, 750 hours performed in those real property trades or business. Colin, does it say anywhere on there that you have to be licensed? Nope. Being licensed doesn't make you a real estate professional. You may be professional in how you act, how about you go about your business. Being licensed is nothing. These are the definitions that you have to use around real property trades or business. What is real property trades or business? That's property development, redevelopment, acquisition, conversion, rental, management. Managing my properties counts. Your time as a real estate agent counts. So your hours, for most people, they're working as a real estate agent. Your time as an agent is getting you to this, right? My point being though, it's not by default you're gonna get this. You have to meet that requirement. So if I worked a regular job, I'll just take myself. So the work that I do, my hours don't count. My full-time job doesn't count. So say I'm working 40, 50 hours a week in my job, I gotta do more than 750, I have to do 50%. I have to work more than 40, more than 50 in real property trades or business. So you might be working with clients that you say, hey, yeah, rentals, they got higher incomes, higher tax burden. Maybe they could get some rentals to do something tax-wise. They may not enjoy the same tax benefits that you all might, because you could get the real estate professional designation. So this is a distinct divider for people in your income situations because you can take a stack of income and offset that with losses without some of those hurdles that the average person has to tackle. Make sense? Okay. Let me go over a couple other things here. So the average person, again, without that, losses for rentals can be suspended. There's an income threshold. You all are basically allowed to go past this, but I need to do material participation in a real estate professional. So let's go further. Example I had this week, had a client invested $100,000 into a real estate syndicate, okay? Which was roughly, I think like a $5-6 million acquisition. When they bought that, so he bought into a partnership, he has a small percentage ownership, gets a K1 for that. It's $100,000 he put in, non-deductible, the investment in non-deductible, but the K1 back had a $75,000 loss because they did a cost segregation on it, okay? And all that means is they did a study, they grabbed a bunch of depreciation and they shoved it through. And they sent a letter out to all the owners and said, hey, heads up, you can get the tax benefits of this big loss. The problem that he had, he was this, but he didn't pass this. So just because you're a real estate professional doesn't necessarily help him in that particular case because he has to have material participation. He's not participating in that. It's an investment in Tennessee. You put the $100,000 in, he's just an investor. That's it. He's not running the deal, he's not involved in it, etc. Without passing that first test, you can't get to the second. So just a heads up, the real estate professional designation doesn't mean that the door is wide open for everything to flow through, okay? Now, there are ways to potentially have that happen. He was asking questions and I said, yeah, you could be a general partner on that partnership, you could be more involved, etc. There's some things that you'd have to do to get that loss. But that's something you have to pay attention to. The type of investment you make can determine whether or not you can have a loss coming back, okay? Anyone here involved, care to share like real estate syndicates or have people involved, adult clients are involved in that? Okay, this is something we hear a lot of where people get confused what's happening. Now, I'm gonna go back to cost segregation. So Colin asked to talk about cost segregation. Anybody here do cost segregation other than on a property, other than Colin? Okay, so cost segregation, what does that mean? So use the example of this real estate syndicate. They bought a property for, let's say, $5 or $6 million. Multi-unit apartment building. Inside that apartment building, there's multiple units. I'll just say, let's say it's 50 units. 50 units, there's 50 set of appliances, there's carpeting, there's HVAC, there's elevators. What a cost segregation is basically an independent party comes in and values all the components of that building. So you got land, you got the building, and all the mechanical stuff. They come in and as an engineering firm, and they break it all down. And they say, this is how much I allocate to the land, this is what's to the building, and this is all that other stuff. All that other stuff was on that list of things that you could accelerate in depreciation. Used to be 100%, last year went to 80%, now to 60% this year. So that's why you've heard more about cost segregations in the past few years. Some people say, is this new? No, it's been around forever. It still can be of value even outside of bonus depreciation, but you've seen more of that comment just because there's been more ways for people to grab depreciation. So if I take that client that had a $75,000 loss, let's say that he could take that. And the question is that valuable compared to your income? So let's say he had $75,000 of income, and he takes a $75,000 loss, and he pays no tax. All right, great. But remember I said those inexpensive tax brackets, sometimes it's not as beneficial to put it against those 10 and 12% brackets. I want to use that depreciation against more expensive tax brackets. Cost segregation is not new deductions. You're just over the life of the property. If it's 27 and a half years, you're just taking future depreciation, you're stuffing it up front. The challenge with cost segregation generally is, so I take from future me to give it to me now, I take this loss and I get some kind of tax benefit based on my income, good. But there's a cost to the study. Most cost segregations, cheapest ones I've seen will be like $3 to $5 grand, could be up to 10 grand. You have to pay for a study to be done. So I say there has to be enough meat on the bone to make it worthwhile. So usually we'll find that most properties under maybe $500,000 or so, it's not as cost beneficial to do that because you got to pay for the study. You're grabbing future depreciation. There's not enough depreciation maybe up front to warrant what you might want to do. So it's not a slam dunk that that's what you should do. Yes?
If you're doing that, accelerating that depreciation up front, so you have less down the road, so then.
I know where you're going, but tell me, I know what you're gonna ask, but tell me the question.
Well,
Let's see if I'm right.
I was just curious, what, you get to a point then that you have no depreciation,
Yes.
before the 27.5-year timeframe?
Not really, it just becomes much more minimal.
Okay.
Yes. I thought I was hoping for one other question, which is gonna be,
What
Happens
what
if you
happens
make
when
more
you get,
next year.
whatever you sell it, right?
Yep.
Okay. So again,
if you sell it before the 27.5
yeah,
years?
yeah, so just in general, depreciation in general. Think of it as the IRS incentivizes you as an investor. They say, hey, you're taking some risk. We'll give you some tax deductions up front, okay? So we'll give you some tax benefit for taking that risk, for buying that piece of equipment. So depreciation just means I buy something for here, its tax basis goes down. Future, I sell it for something, the spread between those two, I got to pay it back. If I'm selling that property, again, I start at here, it goes down to here, I sell it for here, that depreciation recapture, I have to pay that back.
Do you, if you have it for 30 years?
Yep.
Do you still have to pay back?
Yes.
You do?
Yep.
Okay.
Depreciation and recapture is always
there.
in business property, that's correct. So what happens is when people do the cost segs, okay? So again, you wouldn't necessarily say, I'm gonna cost seg something, we're gonna sell it 2 years later. That may not be in the window of opportunity. But if you do take a property and you cost seg it and push it down, let's say it's 5, 7 years down the road, you sell that property. Most people, when you push that basis down, you have some kind of taxable gain on a sale. If it's an investment property, you can do a 1031 exchange. So most people aren't really selling it to get the money per se. What they're doing is they're saying, I'm done with this property, I want to invest in something else. So you could do a 1031 exchange and exchange that property and defer the gain. So for the most part, most people that have any type of significant real estate investment portfolio, they're typically not liquidating that portfolio, they're just paying tax. Most of the time, it's 1031 to something else, to something else. Right now, when you die, then your kids or your whoever's going to inherit, your estate's going to get it, and there's a step up in basis. So this is
Does that depreciation go away on that
Yes.
step up in basis?
Yes, it's all steps up.
Okay.
So the running tax joke, I know tax jokes can be super funny, I know. So, but no, it was ironic. George Steinbrenner died in the year 2000. Okay. It was the 1 year where they were in between these tax laws. There was no estate tax during that 1 year. It was a weird loophole thing. So his estate of whatever it was, like 900 million or something like that. The joke is even in death, he screwed the IRS because he was just like, that's it. He was able to, he died in the 1 year where they couldn't even touch his estate. But in death, there's a step up in basis of property. So think of most significant gains that people have in real estate. Oftentimes you're not going to liquidate it and just pay the tax. It's like a merry-go-round. Once you get on, you're on. So someone says, well, now I've got $4, $5, $6, $10 million in real estate. I'd like to use some of that money, but then you borrow against it. Okay, that's what people do. So while your debt reduction might be going down on property, you might be putting loans or doing lines of credit, refinancing property to pull equity out. Remember, when you pull equity out of a property, you haven't paid tax on that. So you could be taking out taxable gains if it's a large enough gain. That's the idea. So most people aren't really doing, when they have significant gains, they often are not choosing to pay the tax. Okay?
If the depreciation is over with and you move into the property, live there and so you get rid of the capital gains.
You're trying to work every angle.
I
I see there's a, no,
Every exception that you.
so
I
again.
came close
no,
on
I
a
know,
few
I
of
know.
them, that's why I'm wondering.
So just in general, what you want to know, there's no mystery around depreciation. You always pay it back. If you're alive, you're going to pay it back. So I'm going to take that characteristic. I have depreciation, 200 grand, I've depreciated property, I sell it, I got to pay it back. By the way, depreciation recapture is still more cost effective than income tax generally. It's 25%, where normally your income tax rate would be higher. So it's not like you're getting penalized. You got a deduction for it, you just have to pay it back in the future, that's all. So I sell a property, depreciation recapture, boom, it's there. I 1031 it, that depreciation goes forward and adjusts the basis of my next property. I have this property, I've depreciated, it's 200 grand depreciation, I move in, it still sits there. Now, I could live in it for 2 out of 5 years, make it my principal residence, I might be able to avoid some of the capital gains, but and use the personal residence homestead exclusion. But I still, at that time, if I sell it, I still have depreciation.
So if you are purchasing a property, say at 200,000, and then you depreciate it or whatever, and then you sell it for 400,000, are you getting taxed on the difference on the 200
question.
that you made? Or how does that work?
I think I have an example for you, somewhere in here. Oh, before I get to that, yeah, I do have one example. Let me show you this. So these are the 2024 tax brackets. So this is single, married, filing, joint. So we explain the income tax brackets. So these are the tax rates, and these are where they break this year at different rates. The far column, you'll see the long-term capital gain rate. So long-term capital gain is a hold period of a year or more, okay? And you'll see that if I'm in a 10 or 12% bracket here, I actually have 0 federal capital gain tax, okay? A lot of people don't know that. So if my taxable income, marriage filing joint, was 60,000, and I sold stock, 30,000 a gain, my taxable income would be 90. Technically, I wouldn't pay any tax on that federally. Now, there's still state tax. I wouldn't pay federal tax. These are the federal capital gain rates. You can see they're capped at 15% to this threshold right here for each, and it goes to 20. So 20% is the maximum capital gain rate, and you got another anywhere between 7 to 10% on the state. Ooh, I know. Potentially, you could have, there's also what's called a net investment income tax. Have you ever hear that? Obamacare tax. So if you, let's just say that I invested, I'll just use crypto since that Bitcoin. Since now people want to talk about that now. I make 100 grand in Bitcoin gain and I sell it. What tax am I going to pay? I've got Fed tax, federal capital gain tax. I've got state tax. There's no capital gain tax. It's just my state tax. So it could be 15 or 20 to the Fed, 7 to 10 to the state. And then if my income is over 250, I have an additional what's called a net investment income tax or Obamacare tax, another roughly 3%. So the highest capital gain tax that you can kind of pay right now in the state of Minnesota, 20 plus 10 to the state plus the 3, about 33%. So many people think, wow, that's it. Tax those rich people. They should be paying tax. Well, I hate to break it to you because when you sell something, that might be the one time your income has popped up. So if you've got 200-300 of income and then you sell something for significant gain, it's stacked on top of everything. Okay, so you got to be careful if you've got significant gains, and we work with this. I'm dealing with someone right now for this year. They're going to have about a $5 million gain on a business sale. It's their main sale that's going to happen in their lifetime. You have to strategically plan around that. So they're going to blow through all these brackets, okay? And so they're exposed to the highest bracket. What we know is that capital gain tax is always historically more cost effective than income tax. Okay, now I have an example here, right here. So let's say the example was we bought a property for 200. The cost for acquisition, closing costs, et cetera, were 10. That took what's called the adjusted purchase price to 210. We allocate 40 for the land, 170 on the building, and then we've got depreciation of 50 grand over the years. Okay, we've owned this for whatever, 6, 7, 8 years. We sell this thing for 310. What do I pay tax on? So the difference between, if I take my purchase price, subtract out my depreciation, or my adjusted purchase price plus minus my depreciation, I've got 150 of taxable profit. On that 150, it's not all taxed the same. 50 of it was depreciation recapture, 100 of it was capital gain. So my point being, I buy a property for here, I depreciate it down, I sell it for up here. Depreciation recapture is one kind of tax, capital gain is another. Okay, and that's what's basically mixed up. 25% depreciation recapture, and then my capital gain might be 15 or 20%, depending on where that's at, plus my state tax. Okay, that makes sense? Okay. Now here's the other one. I have example 2. I buy for 200, 210 in closing, 210 purchase price. Again, same thing, value of the land, building. I own it for X number of years, depreciate it down. I'm going to sell it for 210. Person thinks, because I have this conversation, people go, oh, I'm selling it for what I bought it for. Shouldn't have any tax. The challenge is that if you've taken this depreciation through the years, you have to pay that back. Okay, so even though in your mind you're like, this property sucked, didn't grow, it didn't go up in value, you might still have a taxable event if you took the benefit of that depreciation. If you did not take the depreciation because income limits, you were not a real estate professional, you weren't materially participating, all of those losses just get pushed forward and used at the time of sale. So the average person who doesn't get the benefit of washing that through, those depreciation benefits aren't lost. They're just kicked down the road to future them when they sell the property. Okay? That make sense?
Of course, the difference being if you can depreciate it, that should be more working capital in your pocket today.
Correct.
Which allows you to accelerate your wealth growth moving forward.
Yes. So 1031 exchange, so we sell this property. Let's use this example here. I take this one. We say, hey, we got 150 grand of taxable profit. Some's depreciation recapture, some's capital gain. Just roughly a third of it is about what you're going to owe in tax. That was just called a third. So that taxpayer is going to have about 50 grand of tax you got to come up with. Now the question is, 1031 exchange, do I eat the tax and just pay it? Or was I going to just turn around and buy another property anyway? Should I reinvest that tax money into the acquisition of something else? That's the question. So to do a 1031 exchange, you have to elicit the services of a qualified intermediary. So the qualified intermediary goes to closing and collects your check. And you can't touch the money. Once you touch the money, it's tainted.
Oh.
So you can't come 3 days after, go, so, hey, can I do a 1031 on that? It's too late. So you have to have a qualified intermediary, go to closing, collect the money, they hold it for you, and then cross your fingers and they show up at the purchase of your next property with those funds. Okay, just kidding. That only happened a couple times.
Yeah.
You have 45 days from the sale of property 1 to property 2 to identify property 2. You have 180 days to close on it. Okay, so you have a 180-day window to move those funds into the next property. What you owe on that property, or the funds you get at closing, we had this conversation yesterday. Someone will say like, hey, do you know what kind of taxable income or what kind of taxable profit you're gonna have on the property? Someone will say, well, at closing, I'm gonna get a check for 120 grand. The check you get at closing is irrelevant. Because what's in that check at closing, you bought the property, you had some principal reduction, your down payment. I mean, that is not what's taxable. If it ever turned out to be the same, that's purely lightning in a bottle. It's the money you get at closing is irrelevant to what's taxable. So you want to know the adjusted basis of that property, and that's what would give you that. Okay? Any questions on that? Yes.
I have another quick question. Doing a 1031 tax exchange, Could you owner finance the property firm to do that, or can you not do that on a 1031
So
exchange?
the rule in 1031 is when I sell this property, let's just say there was a mortgage balance of 100 grand.
I was gonna say 0, but.
But I'm gonna use a mortgage here. So let's say that I owed 100 grand on this property. In theory, I'm gonna get 210 back as proceeds. All those proceeds go to the qualified intermediary. All those proceeds have to show up at closing and I have to use them all. So a 1031 exchange, equal and greater in value purchase price, equal and greater mortgage as well. Okay, so I have to do the same in mortgage. Now, if I had no mortgage, I wouldn't be required to do a mortgage on the next property. I could, I can add money to that, so I could buy, correct. It just has to be more expensive. Real estate is real estate. It's a pretty broad definition. So I could sell a single family home. I could buy a commercial property. I could sell a single family home, buy land. It's pretty broad. Okay, so it's not like you sold a single family home, 2,000 square feet, you have to buy the exact same type of property. It's much more broad than that. Okay.
And Paul, correct me if I'm wrong, but I could sell a property, have 240,000 in equity to move to the next opportunity and say purchase 3 properties.
Yes. So that would be what Colin's saying is you could do a 1-for-1 exchange, sell something, buy one more property. I could do a 1-for-2 exchange. I could sell something for 310, buy 2 properties for 500. Okay. All of those have to be done in that same time frame, though. 45 days, 180 days. That same window has to be facilitated. Okay. So for most people, when they're trying to build their net worth, remember I said taxes are 2 steps forward, 1 back. At theory, this is the way you get out of that trap, because this is how you continue to use dollars that you've never paid tax on to continue to build and grow your net worth and your equity by doing this using time on your side. Okay? Any other questions on that? How are we doing time-wise? I'm gonna keep going or what?
I have kind of a theoretical along with this. So I know like the current administration had thrown around taxing not just capital gains, but unrealized gains.
Oh, yeah.
Where does that stand in your world?
So the question is about unrealized gains.
Because it sucks to pay it when it's realized.
Correct.
It's really gonna suck on unrealized.
So the question that comes up with unrealized gains, just means that you've got gains you haven't cashed in, and you just let it ride till you die, and then all of a sudden someone else gets it and they get a tax rate. That's a lot of what they're talking about with it. To be honest, I wouldn't worry about it, because it's super, what they're trying to do is we're talking about estates of significant billions of dollars, probably, is what they're trying to do.
Okay, so not unlike your average guy that you made 50,000
It
in the
would
stock
be-
market last year. And
Yeah, it'd be a nightmare to do.
Yeah.
Just because there's nobody has the money for it, right? I've got money, I've got stock that went from $1 to now it's $100. I don't have the money to pay the tax, that kind of thing. So I just
Next
don't
year's
see that
worth
ever
50
really,
cents.
I know, I just don't see that ever really happening. A lot of things that's talked about, just going back to when you hear stuff about tax law changes, it's like weaponizing this conversation. So what they do, and you'll see this, I saw this after the State of the Union speech the next day, here's all the stuff in the new tax thing, okay? They love throwing all this crap out there, and they go, just kidding, we'll just do these. It's to fear you, and then they go, okay, we'll settle on this. So there's a lot of that that's happened, specifically in the past probably 10, 15 years, of how they pass tax legislation, is they make you afraid out here, and then they go, okay, this isn't so bad then. You know, that's kind of a lot of what it is. And the reason I'm only bringing that up, not to go into the political side of it, is that this is where we're gonna land with these tax laws expiring, okay? We continue to try to remind people the benefit you're getting running a business, qualified business income. I think that QBI deduction has a chopping block, okay? I think it's out there, it's gonna be out there if you ask me now, but I think it's gonna have an income limit. Because I might say I've got an S Corp and I've got 200 grand of profit and I get a $40,000 QBI deduction, saves me, 10 grand in tax, great. What about those S corporations out there that are making, $400 million, okay? They get this same deduction. So that's what's happening a lot right now is there's this disproportionate allocation. But the other thing I'll say that's thrown out a lot about a lot of the tax law changes is generally they use this threshold of 400,000 and under, you're gonna be okay. You're gonna be okay, okay? And it sounds good when it's maybe in an article or on news that, yeah, right, anyone more that they should pay tax. Well, you may be looking at that person in the mirror because it happens to more people than they think. And I've been doing this long enough to know when I see people like, yeah, rich people should pay tax. And then someone ends up being in that position, they go, this sucks. Yeah, you're considered rich when you make more than 400 grand. And we all know 400 grand is a nice income. I doubt you're considering yourself rich anymore. So the idea is that you have to temper some of that. And so a lot of it is what happens with the average taxpayer. You have a phenomenal lobbyists that work on your behalf for a lot of things. And real estate investment has been a tremendous opportunity for you all to build your net worth beyond what happens with your business. Not only can you make money off of that, but you can use these kind of levers on real estate investment to help offset that. So, okay. Any other questions? Anything off topic you want to ask? Otherwise, I'll shut her down. You want me to keep going? What do you want?
Let's just take some questions. I think
We got about a little over an hour.
I think we filled our time, but Paul is an absolute wealth of knowledge, so please don't hesitate to ask questions. I have no idea what he tells me when I ask questions. So,
I don't know either. I just black out.
yeah, well, there you go.
Cool. Did it help?
Yeah, thank you.
Just in closing, I'll just say this. I mean, if you want to do anything, and I like the fact you're doing that exercise, like where your income comes from, the main thing you want to know, like whether it be from your 22 tax or 23 tax and going into 24, you need to know where your marginal tax rate is, because that's going to tell you what is the driving force of things, okay? If I earn more money, what's going to happen? And the challenge for most people, especially if you have dual income households, W-2 income goes on a tax return first, your business income is on there second. We can't influence anything W-2. You come with, a married couple, doctors making 400 grand each, making 800 grand, complain about their tax, write your congressman. There is no tax planning. You bring a business in the mix, business, rental, that kind of thing, tremendous opportunity for planning, because now you can start to influence that end result. So, okay? Yeah, Colin.
Would you say, Paul, that for people that meet the definition, real estate professional, and they're spending enough time in the business, for those in this room, would you say that real estate investment is probably the most lucrative path forward from a wealth building and tax minimization strategy?
So I'm going to phrase it just a little bit different, okay? I believe that everything is in moderation, right? So there's scales. Here's what I know, and I'll speak for myself personally, and I speak about the people that I know as clients. Myself, clients I know probably have an inherent distrust of Wall Street. Okay? Don't really think some fund manager is going to have your best interest in mind. They're going to give you enough of a rate of return just to keep you happy, but you ain't getting rich off that. Okay? That's the reality of it. So for a lot of people, if this is your net worth, you might say, you know what, I'm going to do a certain percentage, institutional stuff, maybe it's CDs, annuity, whatever, but I'm going to take a certain portion, whatever that fractional portion is, and I'm going to bet on myself. That's what I believe in. Now, betting on yourself can mean a couple of things. It could mean, this is where I'm going to deviate a little bit. I can say I can invest in my business. Marketing, I put 10 grand into marketing, what would that get me? I spend 50 grand on hiring someone, what would that get me? Okay, that's an investment. But I can also say the same thing about property. I put X amount of dollars into a property, what's that going to give me? So I think when you hear people talk about financial stuff, most of it is white noise because they're talking about the average person. The only way they can build their net worth is to climb the corporate ladder somewhere and do some in their 401k. We have a tremendous opportunity to invest in ourselves, reinvent ourselves. As you know, this week is about reinvention, right? So all these things present opportunity, right? Anytime there's disruption, as things are happening in industry right now, it presents opportunity. So I believe in letting me stand up and I'll say, I'll take my 50%, might be 70%, could be 20%, and let me do what I want to do with it first. That's my opinion. Does that make sense?
Absolutely.
Cool. Appreciate your guys' time today. Thank you.
Good parts, Paul?
I don't.
Yeah.
Does your office deal with any internet?
We don't.
Yeah. Oh my gosh.
Yeah. Harder is definitely.
Yeah, for sure.
Yeah,
Kevin, why did you
Haven't been there for a while. No snow.
I know, and my brain here.
Water time.
Yeah, right?
Did you get the house? Kind of cool. Did when I looked at it, you were.
Yeah, I know.
So there's, you're gonna have something limited.
Yeah. So, is this something that's in a trust?
Are you going to there for the day?
Just in a trust? Someone- is it yours?
I don't have it.
Got it. So there's two types of trusts. There's what's called revocable and irrevocable.
Because I have a gap.
Revocable means I can put something in and take it out. I can revoke it. Irrevocable, once something is in there, it's in there. Most people, if they do some type of estate planning with trusts, it's revocable. Meaning that I have a property, I put it in a trust.
Yeah, I mean,
It's still technically my
it's not like an hour.
so they're fairly expensive, it still comes out pretty expensive. So the ownership of the trust. It's just like that.
What he's putting their
Yes,
money on the
so it's
state.
identical to that. It's irrevocable. It's its own. Correct, thank you, I'll pass that on.
Thank you.
So it has its own tax return, it's like its own mortgage. Most people, when they do estate planning, they say, hey, you know what, I want to avoid probate, whatever, I have all my stuff put into a trust. That's just a bucket, it's a name and an ID number, that whole stuff. Then, but it's within tax-wise, it's going to be exactly what I did.
Chris, sounds like you're high,
That's how most people do their estate.
it sounds like we have some other.
Yeah, so what most people would do though is, you wouldn't have, most people don't have a rental.
It's that minute press, just right down the road, so if you are driving down for you,
That's how.
Yes, you can put into the markets.
Name and ID number.
Okay.
That's
Oh, perfect. I'll
property you're running in and out.
Okay, great. Thank you. Of course, sorry that.
You say, yeah, there's something happening to me,
Okay.
make sure my family, take the unit. So the trust actually would own the LLC.
Okay. Thanks, Jen.
Well, with that, my wife and I were talking about
So you kind of have to divide that out, so you know, active has to be the real estate commission business would always be off in its own.
But if he doesn't show up, I'll be here.
I gotta run. I was just curious if you got it done or not.
No, hopefully in a
Next
week or
time,
so.
next time I talk to you.
Yes.
Other entities, and that could funnel down. But your path.
Isn't FTG short for mortgage?
Business corporation. That personally, that's just that's just a check.
I was gonna say, it's probably should, I don't know whether you're nerd enough for Magic the Gathering, but that's a whole other realm.
Are you doing typing today? No, you're not.
I suspect I am.
Yeah, I've sold one there too.
We have supposedly.
Yeah.
Is that right? Yeah, that's
So, once you've created it, you can Right, kind of, you know, what I see like a will says, here's my stuff, here's who's gonna get my stuff. A trust says, here's my stuff, here's who's gonna get it, here's how it happens. So it gives you.
Well, that's good.
Although my one client who I've been working with for like forever, he was all over the place with things. He ended up with a DR Horton like 507 in May. Yeah, he was
That's what
the former coworker. I don't remember it.
the one with a million questions go back.
Have some type of living trust or.
And even the agent there.
Thorough.
Nice way of putting it. So, yeah, he ended up with like higher than he initially thought, so that's cool.
You know, all that.
So like,
Yeah. So we'll grab lunch next week or something. What's going on, Megan?
how are you?
How's it going?
Good to see you again.
Studio, that's what Jason.
Show my face.
Yeah, that's a good thing.
Socialize. Thank you.
And somebody shows up with
All right, take it out. See you later.
Yeah, so just, Mike will start the conversation. By the way, did we just start with
Cool, thanks. This was great. I appreciate it.
Thank
Yeah.
you. Nice to meet you.
Yep, nice to meet you all. See ya.
If you're interested in it, you say that, so probably check out items. Just because I'm, you know, a lot of times I'm kind of strapped for ideas anybody, because to me, it just seems like I'm teaching something every time. Wait, that's not really true, it's, you know, 4 to 6 week rotation. Yeah.
Okay.
Yep. Ooh, let's stop that share, no more Zoom.
I don't know.
April will be, should be her method.
Okay.